Something is happening in the silver market that defies every rule, every historical precedent, and every economic model we've been taught to trust. 37.6 million ounces vanished from the vaults in just 47 days. Gone. Not sold in an orderly market, not transferred through normal channels, but drained as if someone suddenly realized the clock was running out. And here's the part nobody wants to say out loud. The last time we saw a withdrawal this big, in 1980, silver touched $49 and the entire futures market nearly broke. You'll see why that matters later, because the same pattern is repeating now, only this time the stakes are far higher, the participants are bigger, and the consequences reach deep into your daily life in ways you probably haven't even considered. Right now, major South Korean banks have stopped selling silver altogether. Not reduced supply, not slowed transactions. They simply froze the market indefinitely. China blocked its citizens from buying physical precious metals, leaving the state as the only major accumulator. Russia has been pushed out of London trading floors. And something even stranger is happening beneath all that noise. Physical silver is trading at a premium to futures contracts. That shouldn't be possible in a healthy system. Futures represent the cost of storage, transport, and time. They should always be more expensive than spot. But when spot goes above futures, that's backwardation, and backwardation means one thing: panic. People paying more to get the metal now than to get a promise of future metal. A market screaming that trust is gone. But the real story isn't about price. It isn't about charts or predictions. It's about a four-stage pattern that has repeated itself across human history. A pattern so consistent, so brutally simple, that once you see it, you can't unsee it. 3 times before, this pattern has emerged, and 3 times the people who recognized it early made generational wealth while everyone else watched the world change without understanding why. By the end of this video, you'll understand exactly where we are in that pattern, why it's unfolding faster than anyone expected, and what the Hunt brothers' $17 billion disaster teaches you about what not to do as the system strains under its own weight. The pattern begins with stability. A commodity becomes money, trusted for decades or centuries. Governments back their currency with it. People use it every day without questioning its value. Silver defined the American monetary system for generations. Every coin jingling in your grandparents' pockets was real metal. You could walk into a bank with a paper dollar and walk out with silver. It was simple, predictable, stable. A system built on something tangible, something the world agreed had intrinsic worth. Then comes manipulation. Someone realizes that it's far easier to create paper claims on silver than to mine, refine, and store the real thing. 1 ounce becomes 10 ounces on paper, then 50, then 100. Paper promises yield profit. Real metal demands effort. So the world shifts into an illusion where supply looks abundant, where price looks steady, where everything appears under control. Except it isn't. What's hidden beneath the surface is a gulf between physical reality and financial imagination, widening with every new contract printed into existence. And then, inevitably, comes the squeeze. Demand grows. Industrial consumption rises. Investors start questioning the illusion. Some begin demanding actual delivery instead of cash settlement. And suddenly, everyone sees the truth at once. There isn't enough silver to fulfill all the paper promises. Vaults drain. Contracts multiply. Trust evaporates. People rush to convert paper into physical. But the physical isn't there. A system built on convenience and leverage begins cracking under the weight of reality. Finally, the break. The point of no return. The paper market collapses under its own contradictions. Trading halts. Contracts fail. Cash settlements replace delivery. Prices surge, but physical metal becomes scarce at any price. People who hold real silver protect their wealth. People who hold promises of silver learn an expensive lesson about the difference between owning something and owning the illusion of something. That sounds dramatic. It should. Because we're not talking in hypotheticals. This pattern played out catastrophically with the Hunt brothers, 2 Texas oil billionaires who nearly broke the global financial system by exposing the underlying fragility of the silver market. In 1979, Nelson Bunker Hunt and his brother William Herbert began accumulating silver. Not casually, aggressively. They bought everything. Physical bullion, futures contracts, anything that tied them to the metal. 200 million ounces in total. More than half the available global supply outside of government control. Their logic was simple. Inflation was spiraling. The dollar was weakening. The gold standard had collapsed 8 years earlier. They believed fiat currency was dying and that silver, real tangible silver, was the lifeboat. And history seemed to agree with them. In January 1979, silver traded at $6 an ounce. By September it hit 10. By December it hit 30. And then January 17, 1980, 49.45. A 724% increase in 12 months. The Hunt brothers weren't just rich. They were the richest people in America. And Wall Street was terrified. The real threat wasn't the price. It wasn't the volatility. It was the fact that the Hunts were taking delivery. They weren't satisfied with paper promises. They wanted the metal shipped, secured, controlled directly. And that exposed a devastating truth. There wasn't enough silver in the system to cover all the paper claims. As vaults emptied, panic swept through the exchanges. If the Hunts continued demanding delivery, the futures market itself could collapse. And when a system faces a collapse, it doesn't sit quietly. It fights back. On January 7, 1980, the exchange changed the rules mid-game. Silver Rule 7. No more new long positions. You could sell silver. You could maintain what you already held. But you could not buy. A move designed explicitly to stop the Hunts. But even that wasn't enough. Silver kept rising until January 21st, when margin requirements were suddenly increased. Overnight, astronomically, holding futures became impossibly expensive. The Hunts needed hundreds of millions in additional capital to maintain their positions. They scrambled. They liquidated. Others panicked and followed. And then came March 27th, Silver Thursday, when the price collapsed from $21 to $10 in a single day. The Hunts lost $1.7 billion, declared bankruptcy, and triggered shockwaves across global markets. But here's the part almost nobody talks about. People holding physical silver didn't lose. They didn't rely on rules or leverage or exchanges. They held the metal. Even after the crash, silver sat at $10, 66% higher than the year before. They survived. Some thrived. And the world learned a lesson it quickly forgot. When systems break, leverage dies first. Paper dies second. Physical survives. This brings us back to today. Because the underlying structure of the silver market hasn't changed. Only the scale has. The first stage is complete. Silver hasn't been used as circulating money since 1964, when the metal content became more valuable than the face value of the coins themselves. That should have been a giant red flag. When the market assigns a higher value to metal than the government does, the system is out of alignment. But instead of realigning, the world shifted silver into the category of industrial commodity, masking its monetary importance and setting the stage for what would follow. Stage 2 is also complete. Once silver was detached from the monetary system, Wall Street built an empire of paper around it. ETFs, futures, derivatives, certificates. The largest ETF, SLV, claims to hold 440 million ounces, claims, not proves. Buried deep in its documentation is a simple clause. They can settle in cash if physical metal is unavailable, which means you may not own silver at all. You may simply own a promise that someone will pay you the dollar value if things get complicated. COMEX vaults hold only 43 million ounces registered for delivery, against hundreds of millions of ounces in open contracts. 100 claims per ounce. A system designed to function only as long as people don't demand metal. And then something changed. Quietly at first. Then violently. Stage 3 began. Registered silver on the exchange dropped from 80 million ounces in October 2024 to 43 million ounces by December 2025. That isn't seasonal fluctuation. That isn't normal rebalancing. That is a bank run on metal. Withdrawals accelerating. Delivery demands rising. The illusion cracking. On November 17th alone, 6.13 million ounces left the vaults. One day, a withdrawal so large it resembles the early stages of a liquidity crisis. Then came February 14th, when 4 major South Korean banks froze silver sales indefinitely. That decision wasn't about price volatility. Banks with global access to liquidity don't halt sales unless they cannot secure a reliable supply at scale, which means silver availability is tightening faster than the public realizes. China took it further. They increased the risk classification on precious metals, blocked citizens from buying, and required physical deposits for futures trading. In other words, the Chinese state is accumulating, restricting access, and preparing for scarcity while telling the public nothing. Meanwhile, India's silver imports hit record highs as citizens who lived through multiple currency crises rushed to protect themselves the only way they know how: by owning physical metal. Add industrial demand to the equation and the picture becomes even more urgent. Silver isn't just money. It's the backbone of modern technology. Your phone contains silver, your car electronics, every solar panel, every 5G tower, every data center acceleration chip, every missile guidance system, everything you depend on in modern life demands silver. And we are mining less of it each year. Global supply has been declining since 2016. Recycling can't keep up. Production deficits have hit 148.9 million ounces in 2024, with another 117 million projected for 2025. But here's where the alarm becomes deafening. Investors are waking up. ETF inflows surged. Retail buying spiked to levels not seen in more than a decade. Dealers report shortages. Premiums rise. And backwardation appears, spot above futures. Something that signals immediate physical scarcity and suggests the paper market is losing its grip on the narrative. This isn't stage 3 approaching. This is stage 3 in full acceleration. The squeeze is active, ongoing, undeniable. And stage 4 is next. The break will not be clean. It never is. Exchanges will halt trading. They will change rules. They will move goalposts. They will do anything to preserve the system. We already saw a preview in November 2025 when CME halted trading, citing a cooling failure. A multi-billion-dollar exchange with military-grade infrastructure doesn't halt because an air conditioner misbehaves. Veteran traders know what halts during volatility really mean. Someone big is trapped. As the squeeze intensifies, exchanges will face the same dilemma they faced in 1980. Raise margins? Limit positions? Suspend delivery? Or let the market go parabolic and risk total collapse? They will choose control. They always do. But this time, the problem is global. The participants are industrial giants, sovereign states, and millions of decentralized investors. You cannot freeze out the entire world. You cannot change rules fast enough to stop a physical shortage from expressing itself. When the break hits, you'll see contracts settled in cash whether you like it or not. You'll see premiums explode. You'll see silver priced at $60 on paper while physical sells for 100 or more, if you can find it at all. And then one day the paper market will freeze, and lawsuits will fly, and regulators will scramble, and people holding actual metal will sit outside the chaos because they already did the one thing that matters. They own something real. The message isn't about hype. It's about recognizing the difference between speculation and protection. Paper silver is speculation. It's betting on price. It's hoping the system works. Physical silver is protection. It's wealth stored outside the financial grid. It's insurance against monetary failure. You buy it not because you want to gamble, but because you want to survive the moment when gambling becomes the only thing the system can offer. This is the moment to understand the difference between owning a promise and owning reality. The window is still open but narrowing. Premiums are rising. Inventories thinning. Supply chains tightening. And when stage 4 detonates, you will not have the luxury of buying physical metal. The market will close on you. And you will either already own silver or you will be watching someone else protect themselves while you still wait for permission to act. Every fiat currency in history has failed. Every one. Average lifespan, 27 years. The US dollar has been fully fiat since 1971. That's 54 years. You are living beyond the statistical lifespan of a fiat currency. And unlike paper, unlike digital credits floating in banking systems, silver cannot be printed, cannot be created by decree. It must be mined, refined, transported. It obeys physics, not policy. So what do? You recognize the pattern. You respect the data. You understand where we are in the cycle. And you act before the window closes. You choose ownership over illusion. You choose something real over something promised. And you prepare not just to survive what comes next, but to thrive because you understood the pattern when others ignored it. If this opened your eyes, stay with us, because this story is not over. The silver squeeze is just one part of a larger systemic unraveling. Currency crises, debt spirals, derivative imbalances, all following the same four-stage pattern. And in the next video, you'll see how deep this goes, how the pieces connect, and how the coming storm will reshape everything from your savings to your future. Subscribe, stay alert, learn the pattern, because the clock is ticking, and the people who see the truth early are the ones who build the future while everyone else wonders how they missed it.